Earnings season set to pick up again. We're going to be getting the Q3 results before too long. Let's get more from Philip Petursson, Chief Investment Strategist at IG Wealth Management. Philip, great to see you. Thanks very much indeed for joining us. What are you looking out for this earnings season?
Well, we're hoping to see more of the same from last earnings season, which in the United States was a surprise to the upside. We expect that the 7% expected year-over-year earnings growth rate is going to be surpassed. Recall that in Q2, we had 90% of S&P 500 companies surprised to the upside with an average 11% gain year-over-year. So might not be that high, but certainly better than the 7% coming into the quarter is what we expect.
And the U.S. labor market, obviously on the Fed's radar, that's the U.S. central bank's job to keep that stable. You reckon it's not so much companies are firing people, just that job creation is not great?
Exactly. When you look at all of the data, and we have to rely on all the data now, Andy, so you can't just look at the BLS, which isn't putting anything out right now. But if you look at ADP and then you look at the claims data, not only first-time jobless claims, but continuing claims, they haven't indicated that we've seen any kind of meaningful increase in layoffs in the United States. So for now, we think that companies are just on hold. They're not firing. They might be hiring a lot less than they have in the past. But this is a lagging indicator to us. This is something that we think was in place coming into 2025 when companies were uncertain of what the tariff outlook would be. And so they put all plans on hold. We think that, in fact, going into 2026, we can see the labor market start to pick up, and that would be positive for the U.S. economy.
Broadly speaking, start with Canadian stocks, if you would, Philip. What's your strategy right now? Are there any groups that you're overweighting?
Well, obviously, when we look at the TSX, gold has been the stellar performer of the year. Seeing it break through 4,000 this quickly is almost a bit of a surprise to us, as well as I think to a number of investors. But this isn't something that I think can continue. I don't think that we're done with the gold rally. We might not have another 50% increase coming, but a little bit more, maybe 10% or so, I think is realistic. Now, that has been driving the TSX, but underneath the hood, we've seen a lot participation from a lot of different sectors, financials as well. And energy, which the oil price has lagged, but the energy sector has actually done better than expected in 2025. So I would say the traditional sectors that drive the TSX are the ones that you want to continue to focus on.
It is interesting. Maybe we could put up a 5-year chart for XEG, which, as you probably know, is an ETF that tracks the energy producers, excluding the pipelines. And it really has held up pretty well, despite weakness in oil prices.
Exactly. And I think this is more, there's a difference of opinion out there. One is that OPEC, if they start to increase production, that's going to increase supply. And so there's one view that supply is going to meaningfully increase in 2026. But then there's the other view, which we subscribe to, saying that U.S. oil production could taper off dramatically in 2026 as the shale well end their life. And there's been a lack of new investment in shale over the last couple of years. Even though Trump wants drill, baby, drill, companies are saying, look, the price of oil isn't attractive enough for us to put new money at work. So there's this strong difference of opinion. And I think the view that we could see actually tighter supplies in 2026 is what's keeping the energy sector higher than what otherwise the price would indicate.
What about the giant oil sands companies, Philip? Do you pretty well always have a weighting in those in your portfolios?
The big ones, when you look at CNQ or look at Suncor, yes, they tend to pop up in the portfolios. Look, these are great companies, almost regardless of the price of oil. They are very, very well capitalized. They've got great balance sheets. They're buying back shares as well as paying a healthy dividend. And they're reasonably valued compared to what else is out there, whether it's the TSX or the S&P 500. So they're not bad investments, great dividend payers. And I think if investors have a longer term view, we will be using oil for decades to come. And I think these companies will benefit as a result of that.
You touched on the the Canadian banks. Are you at all tempted to lighten up on those with those stocks near record highs?
Well, good question. And I would say no. If you look at it on a price to book value basis and a price to earnings basis, on a PE basis, yes, they're at the upper end of their range, but on a price to book, they're still attractively valued. And remember, we have a steeper yield curve coming as the Bank of Canada, we think, has one, perhaps two more cuts on deck. And so a steeper yield curve is beneficial to the banks. The other element that we think could be coming in 2026 is all of the loan loss provisioning that we've seen out of the banks over the past couple of years. That could be released in a more favorable economic environment into the income statement, and that could provide quite a healthy pop to earnings coming next year.
You mentioned the old steeper yield curve, and of course, that's where long bond yields, longer term interest rates are high relative to short term. And of course, that's great for the banks, isn't it? Because they often take in short term deposits and they love paying low interest on that.
That's exactly it. Think about the bank's business. They borrow short and lend long, and that spread, as that spread widens out, that means more profitability on their books.
What's your view on AI and bubble fears? That is just too much. The stocks have got ahead of themselves, and the investment is just over the top in data centers.
Well, this certainly seems to be the general tone that's out there, and we've been hearing about this for a while now. I don't think there's a meeting I can go through without someone asking about, are we in a bubble for AI? And look, the truth is, you never know until after the fact. But I would say the fundamentals around it are strong. We are seeing AI being utilized by every company out there to enhance productivity. The investments being made into AI by the Mag 7 and other big companies. Remember, this is coming out of earnings. This isn't coming from private equity firms or VCs that are just throwing money at ideas, good or bad. This is tangible investments being made out of corporate earnings by companies that see a significant future. So we're at the early stages of this, in my view. And I would say, while valuations could be or are elevated, earnings are coming in quite strong for these companies that allows valuation to be where it is.
I want you say it comes out of earnings, but I mean, OpenAI, they're not public, I know, but a lot of that money is just venture money that's gone in. And even Meta and Alphabet, I mean, I don't think they produce the actual profits to justify I may be wrong, to cover these hundreds of billions of dollars in announced investments.
No, you're right. It's pick your spot, right? And we are seeing, for example, like Oracle is going to probably have to take on some debt to meet their obligations going forward for OpenAI. But this is very, very different than what we saw in 2000, and I think that is what people are comparing or have in their head when they're talking about a bubble and talking about the money being put into this emerging technology, thinking that, well, is it real? We saw a lot of this in leading up to the dot-com crash in 2000 into companies that weren't real, that really didn't have any kind of idea in terms of what to do, and certainly didn't have revenues to back it. In this case, I do think it's a little bit different. We do see a practical application for every single company out there to utilize AI in their business. And really, it's a chase to who can develop the best program or best version of it that then can be monetized into the global environment, really.
Philip, thank you very much indeed for joining us. Really appreciate it. It's a pity we don't have you in the studio. Maybe you'll make it to our new Scarborough Takes before too long.
I will be there.
Thank you very much. Philip Petursson, Chief Investment Strategist at IG Wealth Management.